Welcome to Apart Market Dynamics from MPF Research. I'm Jay Parsons, and today we're talking about the Pacific Northwest metros, which are just dominating the U.S. leaderboard in just about every key category. And with me to make sense and to shed some light on what's happening is our resident expert on the Northwest Territories, Greg Willett. Greg, what's going on in these metros?
Well, let's just jump right into a chart here and run through some of the numbers that you're seeing there. Again, really good on all fronts. We will start with occupancy. You see right there at the top of the chart, San Jose's occupancy number as of mid-year is 97.6%. That ties the metro with New York for the tightest occupancy rate seen anywhere across the country. Right behind, you have Oakland, San Francisco, Portland, all with occupancy at 96.4% to 96.6%. Seattle's result is a little bit lower at 95% even, but it is moving up quickly. And again, a really strong performance there, well above the U.S. norm. Let's flip over and look at some of the rent numbers in this part of the world, and this is where it's really, really impressive. At San Jose, we've got rent growth of 12.2% between mid-2010 and mid-2011. That includes an increase of more than 7% just during the 3 months of second quarter. Annual growth is at 7.7% in San Francisco, 7.1% in Seattle, and 6.6% in both Oakland and Portland. You look at that group of 5 metros, those are the 5 strongest annual rent growth numbers seen anywhere across the country.
And in trying to explain this data, the first thing we want to do, of course, is look at the employment data for these metros. And you'd expect to see, with revenue growth like that, you'd expect to see some pretty strong employment growth. Well, yes and no when you look at some of these markets. In Seattle, that's certainly the case. Seattle gained 26,900 jobs in the year ending May, according to the Bureau of Labor Statistics. That translates to a growth of 2% annually. That's one of the best growth rates in the country. We've also seen decent job production in Portland and San Jose, which both added about 9,000 jobs over the past year, expanding by about 1%. However, we actually did see some job losses in San Francisco and in Oakland. San Francisco's job count dropped by about 3,500 jobs, and in Oakland, the loss was at 9,300. So, Greg, obviously part of the story in some of these markets is job growth, but that doesn't explain all of what's happening, does it?
There is more to it, and they really kind of break down into 2 categories in terms of what's happening. Let's start with Seattle, which is the different story in these markets. During the recession, you really did have some pretty steep job losses in Seattle. At the same time, a bunch of new supply came online. So occupancy got all the way down to about 92% as at its weakest point, a lot weaker than is normal in that particular market. So what we've seen now, jobs are coming back, new construction has stopped on the delivery front, so it is moving up in the pattern that you would see sort of the normal situation. We did a recent video on talking about surprises in early 2011. Seattle was on that list. That change is occurring more quickly than we thought it would, but big picture, the pattern is what you would expect to see. Going to the other metros in this part of the country, I think part of the story is minor job loss, really for the most part, during the recession, and occupancy came down a little bit. But if you look at the national numbers, occupancy in the Pacific Northwest was still pretty strong during the recession and not that far below what is normal for these markets. Yet they had really, really big rent cuts. So as we've gone into this next phase of the cycle, I think a lot of operators just feel like they cut rents too much during that downturn, and so now they're getting the pricing back to where it was when it was an essentially full market.
So here's the big question then. You know, the revenue growth so far in some of these markets has been so far above pretty much everywhere else in the country. Can that kind of momentum be maintained going ahead?
Well, I'll go back to your yes and no answer that you were talking about earlier. And certainly there's nothing on the radar screen that says we're going to get derailed at the Pacific Northwest. The employment outlook for most leading economists is pretty strong in all these markets. You have not much construction activity. It is creeping up a little bit in particularly San Jose and the Seattle area, but still not a lot that's about to come online, and a huge premium to buy versus rent housing. So it seems like there's minimal chance that we're going to lose a lot of people to home purchase in these markets. So for the next 2-3 years, yeah, I think we could see high single-digit revenue growth to low double-digit revenue growth in these markets. You go on later in the decade, and it's just hard to sustain that pace, and the challenge will be affordability. And you're talking about rents going up much faster than wages would be expected to increase. And so that's going to be hard to sustain. So short term, can it be sustained? Absolutely. Long term, it'll be healthy, but it probably won't be at the levels we're seeing right now.
So there's what's to watch for. And that wraps us up for the Pacific Northwest. So until next time, for Greg Willett and for MPF Research, I'm Jay Parsons. Thank you for watching Apartment Market Dynamics.
Want more? Go deeper with NPF Research's apartment market reports. From a national level, down to individual metros, to specific neighborhoods, NPF Research has been providing unparalleled apartment market intelligence to the multifamily industry for almost 5 decades. Learn more by contacting us at 877-284-4938 or visit www.npfresearch.com and click on Market Reports.